Hey everyone, welcome back to Corporate Decoder. Today, Healthier Choices Management Corp, HCWC, just filed their quarterly report for March 2026, and I am seeing trouble brewing in the numbers. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is really struggling to stay afloat, and their latest report highlights a serious cash crunch. So Healthier Choices Management Corp, or HCWC, has filed their quarterly report showing their financial health as of the 31st of March 2026. And honestly, for a company that is trying to sell us healthier options, their financial health looks pretty unhealthy. Let's dive right into the numbers. As of the 31st of March 2026, the company has about $2.3 million in cash and cash equivalents. That might sound like a lot, but compare it to their total assets, which are almost $30 million. That means less than 8% of their assets are actual cash. Now look at their liabilities. They have over $12.9 million in current liabilities. That means money they owe in the short term. When you look at their current assets, which are things they can turn into cash quickly, like cash and accounts receivable, they only have about $8.8 million. This means they have negative working capital of over $4 million. Think of it this way, they owe more money in the short term than they have available to pay it quickly. This is a big red flag for any business. Now let's look at how the company is actually performing. For the 3 months ending the 31st of March 2026, they reported a loss from operations of over $1.6 million. This is significantly worse than the same period last year when their operating loss was around $400,000. And that loss from operations rolls down to their bottom line. For this quarter, they reported a net loss of nearly $3.7 million. That is a huge jump from the roughly $700,000 net loss they had in the same quarter last year. It looks like they are losing money much faster now. This continued losses is really starting to eat away at their equity. As of the 31st of March 2026, their total stockholders' equity is just about $4.7 million. That is down significantly from over $7.3 million at the end of last year. This shows the company is burning through its reserves. And then there is this other really worrying item. They took a massive impairment loss of over $1.6 million on an investment in another company. This means whatever they invested in is now worth much, much less. This type of loss can really hit a company hard. They also have over $2.2 million listed as Goodwill. This is kind of like an intangible value from past acquisitions. But with the company losing so much money, it makes you wonder if that Goodwill is even worth what they say it is. They did perform a qualitative assessment and decided no impairment existed this quarter. Let's talk about sales. Their net sales decreased by about $2 million compared to the same period last year. They made about $18.2 million in sales this quarter compared to over $20 million last year. Fewer sales means less money coming in, which makes their financial problems even worse. They say their cost of sales decreased too by over $1 million. That is good, but it is mainly because they sold less stuff. And even with lower costs, their gross profit, which is the money left after selling costs, also went down by almost $1 million. And if operating losses weren't enough, their other expenses really piled on. They had significant losses related to debt, an equity method loss, and that huge impairment loss mentioned earlier. All of this added up to over $2 million in other expenses. Looking at their suppliers, HCWC relies heavily on just a few. KeyHe Distributors makes up about 34% of their purchases, and Four Seasons Produce is another 18%. While they say they have alternative supply methods, being so dependent on a few suppliers can be risky if there are any issues. Now, this is probably the most critical part of the report. The company itself is admitting that there are conditions that raise substantial doubt about its ability to continue as a going concern. This means they are warning that they might not be able to stay in business for the next year. They are trying to fix it with cost cutting and new financing, but it is a serious warning. Similar companies that face this same going concern warning have often struggled to survive, like Bed Bath & Beyond or Rite Aid, with many eventually going bankrupt. This means a $1,000 investment could easily become zero. And to top it all off, the company admits that their internal controls over financial reporting are ineffective. They actually list several material weaknesses. This includes issues with segregation of duties. It controls meaning who has access to financial systems and even how they handle related party transactions, which is a big deal when you are dealing with tricky financial situations. This is like a company that is supposed to be counting money accurately admitting they are bad at doing it. They say they are working on fixing these problems, like improving its safeguards and creating formal policies for related party deals. But it is going to take time. and it is concerning that these weaknesses were present in the first place. The company is issuing a lot of new stock though, through series of convertible preferred stock. They've already sold $5.25 million worth and have commitments for another $8 million. This is a way for them to get cash, but it often means they are diluting existing shareholders, making each share worth less. And they've also issued a lot of restricted stock to employees. Looking at their restricted stock activity, they have over 4.8 million shares of unvested restricted stock. This is a lot of potential shares that could hit the market, which could further depress the stock price. Then they mention what happened right after the 31st of March. They converted more debt into shares, which means even more stock is coming onto the market. This is not helping the dilution problem. So to wrap it all up, Healthier Choices Management Corp is facing a perfect storm of falling sales, increasing losses, negative working capital, inadequate internal controls, and a serious warning about their ability to stay in business. They are trying to cut costs and raise money, but the odds are stacked against them. It feels like they are scrambling to survive. The market is already aware, with their stock trading under $1, and as we saw with companies like Tupperware and Rite Aid, when a company enters this stage, the path forward is incredibly challenging. The future looks very uncertain for HCWC based on these numbers. Oh, and the research tools I use for these analyses are linked in the description below. They help keep this channel going. That is my take. Stay decoded. If you found this breakdown helpful, please hit that like button and subscribe for more. Let me know your thoughts in the comments and check out the Discord.